Hey everyone, welcome back to Corporate Decoder, the place where we decode the inner workings of big companies, sometimes finding a few surprises along the way. Today we're diving into the latest report from Consumer Portfolio Services Incorporated, and let's just say it involves some serious money moving around. So, what is the big deal? Consumer Portfolio Services, or CPS as well call them, has just inked a significant deal that could really shape their future borrowing and lending. Stick around as we break down what this means for them. And hey, before we dive too deep, if you love getting these straight up, no fluff financial breakdowns, hit that subscribe button. You won't want to miss out also. We have a fantastic Discord community where we chat about these reports and much more. It's linked in the description below. Alright, let's get straight to it. This is a current report, meaning something important just happened, and it is filed on a Form 8K with the US Securities and Exchange Commission, or CC. Think of it as a company's way of telling the world about major events beyond their regular financial updates. They filed this on the 23rd of October of 2025, telling us about something that went down on the 17th of October. The company at the center of this is Consumer Portfolio Services Incorporated. They are incorporated in California and trade under the ticker symbol CPSS on the NASDAQ Global Market. Now, the key date here is the 17th October 2025. On this day, CPS and a subsidiary called Page 11 Funding LLC entered into a pretty big agreement. They signed a 2-year revolving credit agreement. Let's break that down. A revolving credit agreement is like a flexible loan. Imagine a credit card, but for a business, they can borrow money, pay it back, and then borrow it again, up to a certain limit, over a set period. This particular agreement is for 2 years. The other party involved in this deal are the lenders, primarily Capital One NA, along with another lender described as a Class B lender. So, what is this loan secured by? It is backed by automobile receivables. In simpler terms, these are the payments that people owe when they buy a car on some form of financing. CPS either holds these loans themselves or buys them from dealers, and then they contribute them to their subsidiary Page 11 Funding LLC to secure this credit line. Now, for the headline number under this agreement, the lenders have committed to loaning CPS up to a maximum of $167.5 million. That's a significant chunk of money that CPS can tap into as needed. How much can they borrow at any given time? The agreement states they can borrow up to 95.5% of the value of these car loan payments or receivables that they've put up as collateral. This means they're leveraging their existing loan portfolio to get more cash. This credit facility has a funding termination date of the 18th of October 2027. That is the end of the 2-year period, unless certain conditions trigger an earlier end. Of course, if things go wrong by way of default, the outstanding amounts could become due much sooner. Let's talk about the interest rates for what are called Class A loans under this agreement. The interest rate is a floating rate. It is tied to the 1-month secured overnight financing rate, or SOFR, plus an additional 2.75%. But there is a floor, meaning the interest rate will not be less than 3% per year, no matter what SOFR does. Then there are the Class B loans. These carry a higher interest rate, specifically 3.65% above whatever the total interest rate is on those Class A loans. This suggests Class B lenders are taking on a bit more risk, hence the higher potential return. The report also gives us a look at the immediate impact. On the 22nd of October, just a few days after the agreement was signed, CPS actually borrowed about $19.6 million under this new credit facility. This shows they are already utilizing this source of funding, and they plan to keep using it. CPS intends to borrow more money as they continue to buy these car loans from dealers. This indicates a strategy of using this credit line to fuel their ongoing business operations and growth. Finally, the report is signed by Dinesh Bharwani, who is the Executive Vice President and Chief Financial Officer of Consumer Portfolio Services. Incorporated, he is signing on behalf of the company, confirming the accuracy of this filing, signed on the 23rd of October 2025. Now, let's look at the big picture here. This new credit facility is a pretty significant move for Consumer Portfolio Services. By securing this $167.5 million revolving line of credit backed by their automobile loan portfolio, they've essentially unlocked a substantial amount of liquidity. This means they have more flexibility to fund their operations, potentially expand their business by acquiring more car loans from dealers, and manage their cash flow more effectively. The fact that they've already drawn down nearly $20 million on it so soon after signing suggests they either have immediate needs or are strategically positioning themselves to take advantage of market opportunities. The interest rates, while floating, have a floor which provides some predictability but also means they'll pay more if rates go up. The Class B loan rate being higher than Class A is standard practice, reflecting a different risk profile for those lenders. What are the risks? Well, like any form of debt, this increases CPSS leverage. If the value of the underlying automobile receivables were to significantly decline, or if the borrowers of those car loans start defaulting at a higher rate than anticipated, CPS could face challenges meeting its obligations under this credit agreement. The company's strategy appears to be one of growth fueled by this debt. So a slowdown in the auto market or an increase in delinquencies could put pressure on their financial health. On the flip side, the opportunity is clear: expanded capacity. This facility allows CPS to be more aggressive in acquiring new receivables, which, if managed well, can lead to increased revenue and profits. It also demonstrates their ability to secure financing from major institutions like Capital One, which can be a positive signal to investors about their financial stability and banking relationships. In conclusion, Consumer Portfolio Services has proactively arranged for a substantial credit line, signaling a strategy focused on growth and leveraging their existing assets. While this offers flexibility and potential for expansion, it also comes with the inherent risks associated with increased debt and reliance on a fluctuating market for automobile loans. It's a move that could pay off handsomely if the economic environment remains favorable and their underwriting is sound, but it wouldn't be wise to ignore the potential downsides if those conditions change. Alright, that is our breakdown of Consumer Portfolio Services Incorporated's latest filing. What is your take on this new credit agreement and what it means for the company's future? Drop your thoughts in the comments below. If you found this analysis valuable, please hit that like button and subscribe for more deep dives into corporate finance. And don't forget to join our Discord community linked in the description for even more discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.